All right, we are back with Gareth Soloway, Chief Market Strategist of In the Money Stocks. And Gareth and I are going to continue the tradition of speaking on major market moves. Gareth, how you doing this morning?
I'm doing well, keeping very, very busy, as I'm sure you are.
Yeah, man, I appreciate you jumping on and knocking this out. This is a very important day for a lot of people, and I know you have some wisdom to share to help people navigate what's going on. And I want to thank you. You've been taking a ton of heat since last year at the peak when you're calling for that 20K. Everybody thought you were crazy, insane. And, we had that debate. I didn't think we would break that $30,000 level very easily, which it's been taking a while since the beginning of the year to crack that level. And you've been, holding strong on that 20K. So what are you looking at?
Yeah. So, I mean, number one is this is what happens in bear markets. And what I mean by that is that, we saw the Terra Luna situation. We saw the UST collapse. Anything that's not made to be on a firm foundation, ultimately in bear markets, it's shown to be faulty, right? So now we're seeing Celsius. I think they're not allowing withdrawals right now, which is sending shockwaves. I mean, that's the equivalent in the crypto space of in the financial system. If a bank said, "Hey, you can't withdraw your money," I mean, that is not a good thing.
Well, here's a bigger one. So the latest shoe to drop is Binance. Binance now has locked up withdrawals and not allowing people to take their Bitcoin off the exchange.
Yeah, the one positive, and again, this could change, but the one positive I heard is that it was just based on some sort of glitch and that within 30 minutes, supposedly it was going to be fixed. If that's the case, that would be a positive. If it's not, then you're seeing Bitcoin going much, much lower. I mean, if this is an isolated Celsius incident, that's one thing. If it becomes something that many of these other crypto brokers have, then that's really, really bad. But I will tell you this. What we're seeing today in the price action is what I would consider blood in the crypto streets, which is just the same as blood in the Wall Street, kind of Wall Street period. This is where I start saying, okay, for a short-term bounce, it is starting to be likely. And again, it's scary, but you have to just kind of keep out the emotion and focus on the charts. And I'll show you here. Let me bring up the charts and take a look.
Yeah, and on that note, what's really interesting, so, there are a few people out there still calling for all-time highs and reversals and melt-ups and things like that. The thing to look at on these bounces, you get tremendous bounces in bear markets, and you can go and look at previous bear markets in crypto as well as traditional markets. You're going to get these bounces, but they never go past the previous highs. They generally bounce and maybe test the bottoms of where we came from. So, that's something to just think about on these bounces.
Yeah, absolutely. 100%. And what you can see here is that there's this little interim support right over here at around 23,000 or so. And that's kind of what we've been dangling right on top of. So that's your short-term support on Bitcoin. I ultimately still am holding strong that I think at the high end of a target, you're talking about this 20,000 marker here. So I still think we're going there. But again, generally, you don't go straight to these levels. It's very rare to see a collapse from where we were, at 32,000 or 31,000 a few days ago or a week ago down to 20,000 that quickly. Usually you get to a level, you bounce a little bit, then you flush again. Ultimately, I still think that we could go as low as 12,000. 12,000 is this pivot going back to 2019. One of the reasons why I think you could go that low, there's actually a few. Number one is it's a measured move. So if you take this distance from this high to this low, which was basically a straight shot down, and then you do a measured move, that same distance from here, let me zoom out, from here, it takes you down to 12,000. This would be the same distance repeating, which again, in technical analysis, it's called a measured move. It's some of the symmetry of stocks and charts and crypto. And then the other thing to keep in mind is that 12,000 also is the 80 to 85 correction move, which is a standard kind of Bitcoin crypto winter, right? So again, 20,000 is my high end. That's where I start kind of accumulating a hodl position where I plan to hold it for a little bit longer. But what I'll do is I'll divide my ultimate max that I want to buy into about 5 portions. So let's just say for Pete's, for example's sake, it's $100,000. I would do 20,000 at 20,000. And then at maybe 17,000, another $20,000 worth, et cetera, all the way down. So again, there's lots of ways here. I'm still a long-term huge bull. This is kind of exactly what I was expecting. It's the .com flush out. You need to see 95% of cryptos honestly go away during this next 1 to 2 year period. It's why I've said so many times when I invest in cryptos, I generally only invest in the top 20 because the top 20 hopefully will still be around to tell the tale, just like Amazon back in the .coms. Obviously that one flourished afterwards, but I mean, it is nuts out there. There's no doubt about it. It is painfully nutty out there, and investors don't use leverage. I mean, that's just the bottom line. You use leverage in a bear market, you're going to get slaughtered. Notoriously, when I'm accumulating, like I did a little buying of Ethereum today, I put 4% additional in my portfolio of Ethereum. That's it. So I do have about a 20% position in my portfolio of Ethereum here for a bounce.
Let's take a look at Ethereum too, because I've got some targets on that as well.
Yep,
and I think we might see $700 on Ethereum here pretty soon.
Yeah. And Ethereum has broken down sharply, and really Ethereum is leading the drop. I mean, if you look at the relation to Bitcoin, Ethereum, this was your 2017 high, and it's already through that. Now I do have some
I'm not seeing your chart.
I apologize. Let me bring that up here. And all right, so here's your Ethereum chart. And again, you can see how it's leading Bitcoin. It's already taken out the 2017 highs right here. I think you have a couple levels coming up. The big one for me is going to be this $800 level right here. That's going to be a very, very big support. So again, basically below 1,000, I really start to think that there's good value here. If you can say a cryptocurrency has value. No one thought it would go here. I mean, we were almost at $5,000. So at $1,000, you're basically down 80% on Ethereum, and we're getting awfully close to that, trading at 1225 right now. So yes, it's nasty, but again, if you're someone that has that long-term vision and you're not using leverage and you're trying to build a long-term accumulation portfolio, then you start to nibble. You start to nibble just a little bit, and you kind of say, okay, listen, I understand that these positions could go down 50%. That's just the crypto market, right? Even from here. But if you have that view of long-term, then there's a lot more reward down the line on these good quality names.
Yeah, it's risk reward. And, you have to assume worst case scenario, even if it drops back to, March 2020 levels and previous cycle levels after 2019, you should come back at least to where we are. Are we going to get back to the previous all-time highs? Not without the Fed, not without a reversal. That's just not going to happen without where we came from in that, macroeconomic cycle, I don't believe. But definitely we can get back to these, levels that we came from, because we've seen them before. We saw that 2020 high again. That was in a bull, macro bull market cycle. And, and on your, point about liquidations and leverage, that's a lot of what's going on now. So, now that we've broken that $30,000 level and we've broken this previous all-time high on Ethereum, that's triggering liquidations, not just leveraged traders, but people who have borrowed money, like a Michael Saylor, that have leveraged their holdings to buy more, leveraged their businesses to buy more, things like that. There's levels that are going to trigger liquidations, and the lower the price goes, they have to put up double the collateral or liquidate double the collateral to pay it back.
Right.
So you're starting to see a lot of those things happen, and then, structural fractures in the market. So this is where Warren Buffett will say, now we see who's been swimming naked, right?
That's right. And I mean, and I'm not going to compare what's going on with Celsius or UST necessarily to like a Bernie Madoff, but that's when when Bernie Madoff was discovered was when the bear market in 2008 began, right? Because he could no longer just fabricate the X amount of gains that he was on paper, because people were saying, oh my goodness, the markets are crashing, I need to pull money out. Well, guess what? Celsius is finding the same thing right now. They've stopped allowing that. So, I mean, really bear markets expose the weak hands or the fraudulent hands. And that's what you're starting to see. And it makes a lot of sense. I mean, the crypto market is probably one of the shadiest unregulated markets out there. So in these type of environments, those bad areas are going to get exposed.
And they're going to get attacked. That's what happened to Luna. They were attacked. Celsius is being attacked. Michael Saylor is going to be attacked, by other investors. They're going to force them to liquidate. And, a lot of people are expecting and hoping the institutions will step in and prop this up. But what happens in this environment, and, I guess we can talk about traditional markets next, they've got their hands full over there. So they can't step in over here while they're trying to manage risk over there. So they're not done. They're going to wait. Now they've seen this structural level crack. Now they're going to wait for $10,000, $15,000 before you see big institutional players come in, just like in the pandemic. We're in risk defense mode all across the spectrum globally. So those investors don't have the capital or the risk opportunity or ability to step in right now. Probably.
Right. And that's the key, is that, everyone wants the big player. I mean, it's so funny, right? You see, and this has always been kind of the double-edged sword for crypto, is like, no one wants it to be, everyone wants it to be decentralized. No one wants these big institutions to control so much of it. But then when you get into bear market, everyone's like, oh my goodness, I hope the institutions come out and save the day. And it's like, well, in this environment, like you said, the institutions are not, this is beyond their risk tolerance, right?
Yeah.
They're already cutting back risks by selling Tesla and selling some of these tech stocks. They're not going to come in into something that's dropping by 20% a day and step in at these levels. Now, at some level, hedge funds who really do take risks like that, they will step in, but they wait for, the absolute collapse. They'll wait on Bitcoin to sub 20,000, probably even sub 15, like you're saying, before they step in.
Well, a lot of those have already unwound. They're already down 50, 60, 70%.
Right.
So they don't have the resources to step in. And like you said, they can't risk it all on this last trade, but they can step in and drive it down, because it costs way less to drive it down than it does to drive it up. And I think, a lot of people don't realize that. And this is all just for people watching, just some things to think about. But all of this, will ultimately create, those really exponential opportunities as well once the dust settles.
Yep. And I think this goes to the kind of the thesis of like, so I've been nibbling on Bitcoin down here, and I've been nibbling on Ethereum down here as we're getting to these kind of crazy sold short-term levels. Some of the things that I'm intrigued by is you have something called a time count here, which is 2, 4, 6, 7 straight down days in a row. If you look at charts, they tend to bounce after. If you get 7 red candles or 7 green candles in a row, you tend to get a short-term reversal in trend. It may only be short-term, but for me as a swing trader, that's an opportunity. But again, what I'm doing here is I'm not like betting the farm, right? And people are just so insane when they do this, especially in a bear market. When you're going counter trend to the market, you literally dip that toe in the water. So you're talking about, 4%, 2% of my portfolio, what I'm putting at risk initially, and then maybe I'll add another 2 or 4%. But you're not going like 10 times leverage in, praying and hoping that this is the bottom, because that's how you go broke in a bear market. And again, things have changed. Investors have to understand that the days of 2021 are now gone, because the Fed has said, sorry, guys, we are not continuing to print money. And the government is in that same position. You don't have enough people saying, okay, let's do this spending bill or this spending bill. And so all of a sudden the spigot's been cut off and the market's kind of left naked, if you will.
Yeah. And they can't do anything right now because of inflation. And it's a global problem. Yep. It's not just the United States. And a lot of people were saying, oh, they're going to stop. They're not going to raise as much. They're going to pivot until inflation is back down, under probably 4%. The Fed cannot stop. They just can't stop, because inflation will do more damage than the market, deleveraging and unwinding that we're seeing. Way more damage.
Way more
too
damage.
much, too much bubble pop and, junk that's got to be cleared out of the system, like you've been saying.
The one thing I will say is like, so the inflation numbers are ridiculously high right now, but the Fed has to be very careful here, because you are seeing consumers starting to recoil like they just touched a burning hot stove. All right. Again, so far we're still seeing, we're always hearing, oh, the traveling because COVID's, kind of down and over at this point. But I'm telling you right now, from what I'm seeing, people aren't driving as much as they were, because it takes $120, $130, $140 to fill up your tank just for a few days of driving. Right. And then you also have prices that are ripping higher. We know that housing has been just going nuts. So people can't afford that with interest rates where they are. And there's this massive recoil that's starting to take place, and it can force us into a recession far, far faster than anyone thinks. I went on record, I think 6 months ago, saying we could easily see a recession start by the end of 2022 into early 2023. And I think that's going to happen. And then
we're already in it. And, and to your point, people will take their summer vacation, but that's it. So they're already pulling back. They're not eating out. They're not driving excessively. Like you said, the spending is way down. People's behavior, is changing. And it takes a little bit more time, because the academics, the economists, and, the theorists out there, have been, pushing that narrative that inflation's peaked and it's coming down. Inflation is not peaked. I've been saying for the last 3 or 4 months, it hasn't peaked. We haven't seen the top. I don't know what they're looking at. It's going to take a couple months for it to peak, if it can, in a couple of months. And the Fed, they haven't really done anything yet. Still, they still haven't done anything. And that's what a lot of people aren't realizing, because everybody's like, it's priced in. It's priced in. It's not priced in, because they haven't even started yet. And that's what we're seeing right now. We haven't even dropped, to the levels, like we did in 2018, the last time the Fed tried to, stop QE and raise interest rates. I mean, the market's
Yeah,
dropped, what,
and you'll see. I mean,
30%?
basically, number one, it takes some trickle through effect, right? So especially when prices go up on the producer side, they're not going to like raise it all in 1 month and pass it on to the consumer, because then you would see the consumer stopping to buy their goods. So what they do is they try to do it more incrementally, which keeps inflation higher for a longer period of time. We then talked about wages. I've talked about this with you before, but as good as it is for people to earn more money and get paid more, at the same time, it does cause an increase in inflation as well. And so you have all these kind of trickle through effects. And I do think inflation will come down as people recoil. We saw, I think it was Target News last week that said, they had a huge inventory, so they were going to start marking down things. So I do think inflation eventually does come down, but people are going to react to their 401ks getting cut down by 20 or 30%. Smaller investors seeing crypto markets collapse and their portfolios down 50, 60, 70%, they're going to react to that. That's wealth effect that was created during COVID is vanishing very, very quickly.
Yeah. And the good news is all of this will come back once we reach a bottom, once inflation's under control. And, once we can, the Fed can stop or slow down, we will reach that point. And, what's interesting here is, and something to look for is, now we've reached a new base at that 23, 24. I've been kind of eyeing that little checkpoint that we're at right now. We could consolidate there and bounce, 22 to 25, 24 in that range for several, weeks, like we just did at this, 25
Absolutely.
to 28 level.
No, 100% right. And that's kind of what I'm thinking too, is I don't think it's as easy as, I mean, maybe we flush quickly to 20, but generally bear markets don't end this quickly. So I think it's got to be a little bit more drawn out. I think if you look at past bear markets in general, it's taken about 12 months from the peak on Bitcoin, for instance, to get down to its low before then it goes choppy sideways for about 6 months before it starts to kind of increase. And we're, if we look at November being the high, we're still quite a ways away from November now when a potential low could be put in. So it'll be interesting to see. And again, the more interesting thing for me is going to be, what does the Fed do when we do enter a recession if inflation is still at 6% or 5%? How do they react when they can't print ad nauseum the amount of money that they were in the past?
Yeah, that's next month, because inflation is going to be hotter next month than it was. Well, we're going to see June print next month, May print this month. The big thing is this week, when the Fed meets this week, if they go 75 or 100 basis points, we might shoot right down to that level. If they don't, if they just do what they said, 50 basis points, we'll probably grind this level out and just kind of check that 23 level for a while, and maybe it breaks. But that's kind of what I'm thinking. If they come out hard and do 75 or 100, we're going to see that next leg down across the board. If they don't, we might see a little bounce and just kind of grind these levels out for a little while.
Yeah, totally. No, it's amazing. I mean, this is definitely a market that investors need to understand. So many investors came in after kind of the 2020 flush with COVID, and they've never experienced a longer term bear market. And it's kind of a wake up call. I mean, I know you and I have been through many bear markets out there and collapses, but there's a lot of the population that hasn't been. And it's like, it's, welcome to the club, essentially. Unfortunately, it's a club that we don't necessarily want to be in, but it is a club that everyone becomes part of.
Yeah. Let's take a look at traditional markets and see what you're looking at there. But yeah, this is all, a lot of the people out there on YouTube, a lot of the on-chain guys, I mean, they didn't even get into anything until after, last few years. They haven't seen 2009 type stuff. They haven't seen, 1990s type stuff. And, you can go back and look at the markets and you can see the patterns and how they work. And this stuff takes a while. When you're in a real legitimate macro bear market globally, it takes years for this stuff to unwind and bounce. And that's what people don't realize. They're used to these V-shaped recoveries because of the Fed response. The Fed can't respond. So this is going to take a while.
Yeah. So we have the S&P here. So pre-market, when we're doing this interview here, we're trading right at this little pivot low right here, which is around 380, 381. So that's going to be a big level to watch today going into the rest of the day. I still think these equity markets, and I think I've even said this since late 2020, 2021, is that you have to, if the Fed is really withdrawing liquidity and stopping the QE, then you're likely going back to that pre-COVID high. So that's still at 340, which is still, from the pre-market levels here of 380, we're still talking another 40 points on the spiders to the downside. That's 400 on the S&P 500. And that's, once we get there, I think you get a sustainable bounce. I don't think it's the bottom for the markets because, again, I still don't think inflation will be under control, so the Fed can't print money again. But I do think you'll get a kind of like, okay, we've washed out all that fluff and all that money from the COVID massive stimulus. Now let's kind of reevaluate with where the economy is. And then probably the next leg comes in 2023 when we are officially in a recession and people start worrying about how bad of a recession. Is it going to be a depression? You'll start hearing that. Is it going to be stagflation? I mean, all of these things could be the next leg down, but I think just what we're in right now takes us to 340 on the spiders.
Measure that 2018 drop there. What was that percentage back here in 2018?
So we'll call it 340 down to.
Now that's 2020. Go back to 2018 before that.
Oh, 2020.
Yeah, that's the last time the Fed, did what they're doing now.
So at 293 down to 230. So 290. So 60. It was about 20, just over 20%.
Okay. And where are we at now in our current drop?
S&P 500, 480 to 380. So that would be just under 20%, right?
Yeah.
Or actually, yeah, right around 20%.
Yeah. So we still have got, a little bit of ways to go before we even catch up to where we were in 2018. And what recovered was the pivot. We can't pivot now. So,
right. That's what I was just going to say is that in 2018, the Fed backed off and went back to money printing within months. They can't do that now. So to me, this is a scenario where it's very likely you'll see double that drop, because they can't come out and rescue it.
Now, here's the really ugly thing is that, I believe, with you, we're going to test those pre-pandemic levels, but those were record high levels as well, coming off of 10 years, 9 years, or no, how long has it been since 2009, QE, zero interest rate. What if, or is it even possible to get back to pre-2009 levels before all that started?
Yeah. Yeah. I mean, that would be incredible to get back to that. I mean, I have to even go to my weekly chart here to get back to that.
Yeah, you got to get on the weekly and, think about, where that was before, all of this big melt up started.
I'm a big believer that markets revisit levels. So for instance, if you look at the weekly and you go back to the high, so we have this beautiful double top going back to 2000 and then to 2008, right? So right there. And again, this is kind of that horrible scenario that none of us hopes happens. But if we get into that really horrendous, Great Recession, Depression-ish type scenario, it would not shock me to see the markets retest this high. We never really retested it. Once we broke out, we were off to the races. We never, ever retested it. That's somewhat unusual for markets. Usually markets, what they do is they break above it. And then what they'll do is they'll check back to it, right? So if you draw the trend line through here, they check back to it and then they go on their merry way. We never did that.
That's because, zero interest rates, QE, all of that since the bottom of 2009 and 10. And in addition, like a lot of people watching this don't even know this. That's when the government was bailing out companies. They were coming in and loaning money to companies, bailed out GM, bailed out, banks, all that kind of stuff.
Airlines. Well, they did that again in COVID too, but yeah.
So all of that is unwinding. So that's something I've been watching and just kind of thinking. I'm not saying it's going to happen. I'm not predicting. I'm just saying, what if you go back to an organic market without Fed intervention, without QE, without zero interest rates, and let the dust settle? Seems to me that that's probably where it would settle on traditional markets.
I agree 100%. And again, people would say, well, that would be way too low in terms of price to earnings on the S&P. But you have to remember that if we go into a bad recession, those earnings estimates are going to come way down. And by the way, they haven't even been dropped yet by analysts. That's still coming. That's still another shoe to drop here just for what we're going through right now, let alone if we get into a bad recession where they're going to get taken down even more. So it's, well,
PE is relative to interest rates, right? So your PEs adjust with interest rates. So if your rates are back to where they were, back then, your PEs will adjust back then. The only reason we have them where they're at now, 14, 15 times, is because zero interest rate policy.
Right. 100%. You're right. And that's been my big gripe with Apple is that, you look at Apple, it was a $3 trillion company. And how do you justify when it was at its highs, a 30 PE ratio? I mean, historically, a company like Apple would be at like 12 or 10, which is really scary because think about the amount of downside on that. And you're talking about cutting the price target by 66%.
We saw those drawdowns in 2001. We saw, NASDAQ drawdown, what, 70%, 60%.
Yeah,
We saw S&P and Dow draw down probably 50% or something. And,
incredible.
we saw those levels draw down, same thing in 2008 and 9. So interesting. I'm not saying that's going to happen. I'm just saying it's an interesting kind of thing to look at. I feel like right now, those pre-pandemic levels are the next target.
Yeah, and I have to run in a minute to get ready for the market open, but I want to say this to everyone. Obviously, Greg and I are talking very bearishly. Understand that in bear markets, the opportunities are incredible, but you have to be very careful. And I've had like my swing trading year has been going long most of the time, but I'm buying specific dips and then selling the quick rips. And so my point is that bear markets are not the end of the world. Yes, you have to be nimble. It's not easy, like closing your eyes and throwing a dart at a board and just making millions of dollars. But bear markets breed the best opportunities for investors in a big period. So just keep that in mind, is that as bearish as it may seem out there will be opportunities, but you actually have to use intelligence, right? It's not the close your eye market where you can just pick anything. So just keep that in mind.
Yeah, I'm glad you said that. This is an opportunistic conversation, not a bearish conversation.
Right.
These are opportunities. I've made my biggest moves in the bottom at 2008-9. That's when I jumped into the markets for the first time, bottom of March 2020. These are the types of things that I like and that I look for, not because, other people that are struggling, hurting, whatever, but just from opportunities. These are the times to make those moves. So thank you for pointing that out.
No problem.
Awesome, man. Well, Gareth, thanks for jumping in here, and I'll get this out real quick for everybody, and I will see you on the next video.
Awesome, Greg. Thanks for having me. Great talking to you. I'll talk to you soon.
Yep.